For Your Money is brought to you by NelsonCorp Wealth Management.
It's now time for Your Money. We're joined by David Nelson, CEO of NelsonCorp Wealth Management. Welcome back, David.
Thank you very much.
So we have talked several times this year about the weakness in the bond market. What's the latest on that front?
Well, we're starting to see some improvement as far as on that front. Most of the year, as people probably out there are aware by now, stocks and bonds have been moving in sync, which is quite rare. Generally speaking, what you'd see is stocks are going down, bonds are going up. That hasn't been the case as far as year to date. The expectation is that the Fed's going to continue to increase interest rates, and subsequently, again, the bond market's been suffering because of it. This chart I brought along today, I guarantee people, if they pay close attention to this, they're going to get great value from this. I love this chart. So the blue line is looking at the bond yield, the curve as we call it. And on the left is showing as far as the 2-year bond, what it's paying. And then on the far right, it's looking at the 30-year bond, as far as government bond, what it's paying. And then the red line is looking at basically break-even points. And what it's illustrating here is that on the short end, the 2-year part of it, that interest rates could go up almost 1.4%, and that individual would not lose money as far as for the year. Now, again, keep in mind, folks, that teeter-totter that we talk about all the time. When interest rates go up, the value of bond goes down. And what we're trying to illustrate here is that if you look at the long end to the right, interest rates can't go up very much and you're going to lose money. On the short end, they could go up 1.4%. and you'd break even for the year. Not that people want to break even, but the bottom line is it would allow you to break even for the year.
All right, so what implications does this have for viewers' investment accounts?
Look at the short end of the curve. I know time is tight here. The short end of the curve basically is going to give people probably the best risk reward while protecting their capital.
All right, David, thanks for your insight.